It's a normal Tuesday morning. Coffee is brewing. Kids are getting ready for school. And for millions of American families, life feels completely under control. Bills are being paid. The mortgage feels manageable. The future looks stable. But what most families don't realize is that one unexpected moment can completely change everything. Every year in the United States, more than 150,000 families lose a primary income earner unexpectedly. And when that happens, something terrifying follows. Not just grief, financial chaos. Mortgage payments still exist. Car loans still exist. Groceries, childcare, medical bills, all of it continues, even when the income disappears. And this is exactly why life insurance exists. But here's the problem. Most people buy the wrong kind. Two types of life insurance dominate the market: term life insurance and whole life insurance. Both promise to protect your family, but they work in very different ways. And choosing the wrong one could cost you hundreds of thousands of dollars over your lifetime. Let's imagine a very real scenario. Mike is 34 years old. He works in construction. His wife, Sarah, works part-time while raising their daughter. Like most families, they rely heavily on Mike's income. The mortgage, health insurance, groceries, everything depends on that paycheck. One night while talking about finances, Sarah asks a simple question. What would happen if something happened to you? It's not a fun conversation, but it's an important one. So Mike starts researching life insurance. And that's when he discovers something confusing. There isn't just one type. There are two major options: term life insurance and whole life insurance. Let's start with term life insurance. Term life insurance is the simplest form of life insurance. You buy coverage for a specific period of time, usually 10 years, 20 years, or 30 years. If you pass away during that time, your family receives a payout. If the policy expires and you're still alive, the coverage simply ends. That's it. No complicated investment features, no hidden structures, just pure financial protection. Think of it like renting protection during the years your family needs it most, when the kids are young, when the mortgage is large, when losing an income will be devastating. And because term insurance is simple, it's usually very affordable. A healthy 30-year-old in the United States might pay around $25 to $40 per month for a $500,000 policy. That's less than what many people spend on streaming subscriptions. So if term insurance is that affordable, why do some insurance agents recommend something else entirely? That's where whole life insurance comes in. Whole life insurance works very differently. Instead of covering you for a specific number of years, it covers you for your entire life, as long as you keep paying the premiums. But here's where things get interesting. Part of your payment goes toward the insurance coverage, but another part goes into something called cash value. This cash value acts like a savings account inside the policy. Over time, it grows, and in some cases, you can borrow money from it later. But this extra feature comes with a huge difference. Price. Remember the $30 term policy we mentioned earlier? A whole life policy with the same coverage might cost $400, $500, or even more each month. That's a massive jump, which raises a big question. Is whole life insurance actually worth the price? Or are families paying thousands of extra dollars for something they don't really need? Most financial advisors recommend something called buy term and invest the difference. Here's the idea. Instead of paying $500 per month for whole life insurance, you buy a cheap term policy, then invest the remaining money yourself. If that difference, around $470 per month, is invested into something like a basic index fund for 30 years, that money could potentially grow into hundreds of thousands of dollars, sometimes even more, which means a family gets protection and builds wealth separately. But that still leaves an interesting question. If whole life insurance is so expensive, why do some wealthy families still use it? In certain situations, life insurance can offer tax advantages. The cash value inside some policies grows tax deferred, and loans taken against the policy may not be taxed the same way as regular income. This strategy is sometimes called infinite banking. It's complicated, and it's definitely not for everyone, but it explains why some high-income families still use life insurance in creative ways. When people research life insurance online, they usually ask the same questions. How much life insurance do I need? Is whole life insurance a scam? And when should I actually buy a policy? A common rule used by financial planners is 10 to 15 times your annual income. So if someone earns $70,000 per year, they might consider around $700,000 to $1 million in coverage. This ensures their family can replace lost income long enough to adjust financially. The best time to buy life insurance is when you're young and healthy. Insurance companies calculate prices based on risk. The older you get, or the more health issues you develop, the more expensive policies become. Waiting too long can cost thousands of dollars over time. But the biggest mistake people make is actually much simpler. They assume they don't need life insurance yet, until suddenly they do, and by then it might already be too late. At the end of the day, life insurance isn't really about money. It's about protection. It's about making sure that if the unexpected ever happens, the people you love most aren't left facing financial disaster. For most families, simple term life insurance provides a protection they actually need. But understanding how these policies work can help you make smarter financial decisions. Thanks for watching. If you found this video helpful, make sure to subscribe and turn on notifications for more videos that break down insurance, taxes, and personal finance in simple terms. Our goal is to help you make smarter financial decisions and protect your financial future. And we'll see you in the next video.